the Fibonacci tool for the end of the Fibonacci section. Now, I'm sure by now you have an idea and you've more or less got a grasp of how we use and utilize the Fibonacci tool. The different levels, whether they be retracement or extension. What I'm going to go over in this video is something that I've more or less refined over the past 4 to 6 months due to some market conditions, and I'll go a little bit further into that shortly. I've just refined some parts of the Fibonacci tool, and I've already put this out on some of the webinars and the webinar recordings. You guys, especially if you're new, may have seen this. So I'm going to go into further detail for deeper understanding. Now, if I just firstly start by drawing a fib tool onto the chart, Fibonacci retracement. So let's go from high down to low. Now you notice my fib, if I go into the settings, you'll see 38.2, 50% are unchecked, and also I've taken off one of the Fibonacci extension targets, which is known as D2. Okay, so I've unchecked 38.2, unchecked 0.5, which is 50%, and unchecked one of our target levels. So this is what it now looks like. Fib from where I've just drawn it, from top, fib A, down to fib B. Let's say fib B is here. Generally speaking, we wait for a pullback up to one of the levels. And remember, we would have had the 50% right here, then the 38.2 right here. But as you can see, I've taken them off. C, and then we now expect a new lower low to form into the region of D. And if I just go into the fib tool, if I just show you, as you can see, there's fib D1, the fib D2. There's 38.2 and there's the 50%. So normally we would be expecting a rebound from either 38 or 50 or 61 down to either target 1 and target 2. Now the reason why I've done this as well, there's two reasons for why I've actually done this. Reason number one, when I was studying the fib and utilizing the Fibonacci, not recently, and when I say recently, probably around 4 to 5 weeks, probably around 6 months, 7 months, 8 months ago. The reason why I did this is because the major currency pairs, Euro USD, Aussie dollar, GBP USD, which I was studying day in, day out trading, were actually ranging in between huge monthly ranges. So when I ever tried to apply fib, it was quite difficult, and not just for me but for other students as well, to know which Fibonacci we had to actually take a trade base from. Was it the 38? Was it the 50? Was it the 61? Do I hold from here or to here? And the reason for that was because the market condition at the time, we were in consolidation ultimately overall. However, excuse me. However, it became quite hard because of the consolidation and because of the market moving sideways, back and forth, back and forth, back and forth, before actually creating a new leg, whether it be to the upside or downside. It was quite difficult to decipher which actual level we trade from and where to place our target. I knew personally, but again, for others who are, especially the guys who are new, it was proven to be quite difficult and confusing. So what I've done, I've refined the fib, and you guys can have a go at this on your own. You can check out the webinars as well. Remove the 38.2, remove the 50%, and remove D2. So now what we're left with is fib A, 100% down to fib B. Fib C is going to come into two variables. Fib C is either going to be a tap at the 61.8%. Okay, and I'm sure you guys have experienced, I've seen the market actually tap the 61.8 to the T sometimes, whether it just be a wick or whether it be the candle spikes through it and the body closes below. We're looking at a tap at the 61.8, or we're looking for a reversal or rejection anywhere in between the 61.8% and the 78.6%, which I'll show you in a moment. That's one, that's two. And what we can also see finally is a tap or rejection of the 78.6% fib in itself. So what can actually happen there? Three variables. We can see the market pull back and tap directly. If I just remove this for a second. Oh no. No. Okay, I'll just get rid of that for a moment. Number one is tap directly at the 61.8 per se, then rebound. Number two is to fill and reverse, okay, within the region of 61 and 78.6, anywhere in between here, and I'll explain why afterwards. And number three is for the market to potentially come up, spike through to 61.8, and then it could spike through to 78.6. I'll go through the ins and outs of that afterwards, but it can reject the 78.6. That's mainly on a 4-hour time frame. With this as well, guys, I do recommend we just stick to the daily time frame and the 4-hour time frame. Always start firstly on the 4-hour, then come into always start firstly, on the daily, then come into the 4-hour time frame. So what we're actually looking for on here, every time I draw this Fibonacci on, oh, and forgot to mention, this is always going to be our target, first target. We can look at the 0 if it lines up with any of our key levels of support, resistance, monthly, weekly, or daily. However, we've just narrowed it down to one target. So we have one area for the price to bounce from and react from, right here, 61, 78, or in between. So what we like to do, what is great, is when you draw this Fibonacci tool on, put always, get the rectangle tool and draw a nice, neat rectangle in between both of those, like so. We don't need to draw a rectangle at a target. I was just highlighting that purely just to show you guys that we just have one target now. But what we've done here is we've actually taken off the 50, taken off the 38.2. So now, if we just stick to simplicity, simplicity is key, less is always more in the markets, okay? And if you practice this over and over and over again, daily time frame, 4-hour time frame, daily time frame, 4-hour time frame. If there's nothing there on the daily, simply step down to the 4-hour time frame in order to see if you can find any of these that are setting up right now. It also helps, obviously, I've mentioned this in other videos too, if we do have one of our key levels anywhere, whether it be at the 61, in anywhere in the region, or directly at the 78.6, that's just add confluence. Okay, obviously we want to take into consideration everything we've done before this top-down analysis, reading the market from top to bottom, looking at the moving averages. Moving averages are coming soon as well, further down the member sections. Looking at the moving averages, looking at the overall direction, the filtration of the trend, and going in that direction if possible. Looking at the previous swing points that we've already marked onto the chart. So we always start on the daily. Have we got any daily swing points on there? Then we come into the 4-hour. Again, we just want to stick to those time frames. And then we can apply fib to see, is the market lining up, or is it already just rejected this region, ready to go short to our target? So that's how the fib is going to be set up going forward. As I say, it can come anywhere in between this region. You guys don't have to do this if you're comfortable with the other settings of the fib. That's great. However, now this is in the book towards the end of the fib section. What invalidates this Fibonacci is if we put this on a daily candlestick, a daily time frame, and a daily candlesticks run up, and we get a daily candle which closes above. So we've got a nice green candle there. The daily candlestick closes above the 78.6. On that day, this Fibonacci is now invalid. You scrap it. Why is it daily? Because the 4-hour can breach this region in between, and it can breach temporarily the 78.6 and then be whipped back below. So if you get a 4-hour close up, maybe that same bar closes down and leaves a wick, i.e. rejection. Or we get a 4-hour candle that closes up, then the next 4-hour candle may drag it down. And if it actually drags it down and the day closes back below that, you will see on the daily time frame a daily wick rejection. I will see if I can find any details on this and any examples in a moment. So 4 hour time frame, a close above, no, you always have to wait for the daily candlestick to close above. Take the Fibonacci off, it's likely to reverse trend. Why? Because if we think of the 78.6 level as being 80%, if the market retraces past 80% of its previous move, there's a high chance and high probability and there's a likelihood that this may now reverse trend. What we're looking for is the market to pull back into this region, and why many people often fail and get stopped out with a fib is because when they trade from the 50% or when they trade from the 38.2%, which we've taken off, the market may run up past and beyond that point, and the stop loss placement, generally speaking, is randomly above the 61.8 for those traders. Now, market psychology, if the market is going to come up and hunt people's stops, it's likely to come spike either to that sometimes or in this region. It might spike in between the region, stop people out, then go short. So what we want to do is we want to capture the reversal point where the market is finding states of exhaustion in itself in order to then continue in the overall direction, the move, and we're always going to get the best risk reward trade. So more or less, we're looking at where people are getting stopped, and this is where we're trying to find executions and setups to actually go short in this case. So refining this right down, you're always going to get the deepest pullbacks and the best risk reward setups. So it takes out the confusion. Do I trade from the 50 to 38.2, or do a trade to target 2? Always trade to the minus 27, the target 1. Be mindful of what's here at 0. It could be some support there from previous. And we're always going to, in this case, we get our short tool. In this case here, let's just say the market came in, rebounded, provided us with an opportunity, whether it be candle formations, etc., to go short. Now, our stop in this case, so our target, let's say our target's generally going to be a target 1 on the fib, easy as that. Let's say we enter around here when the price dips back down for whatever reason or price action confluence we may see or reversal. Our stop loss is always going to go 10 to 15 pips. I would say 15 pips above the 78.6. So here, the price of the 78.6 is 1.2754. Let's just round that off to 1.2755. 15 pips on top of that is going to come in at, come on. This thing is so damn fiddly. Let me just get another one. The stop loss 15 pips above is going to actually come in at 1.2770. So let's say we entered here. We line it up 2770. So here on the right axis you can see 1.2770. Okay, target 1. Our fib there as well. So look at the risk reward on this. The risk reward ratio is 1 to 3. We are risking 46 pips for a grand total of 140 pips to round that off there. So stops on this are going to be generally relatively tight actually, especially if you are working on the 4-hour time frame. But this is how to refine the Fibonacci. And again, practice. Perfect practice makes perfect. So if we're doing this the correct way over and over and over again, things are going to implement, new structures are going to implement in your mind over and over again. If you're just looking for this and you have your trading checklist there, you've done your monthlies, your weeklies, your dailies, you're looking at the moving averages, you suss that out, you're making notes by hand as well as taking screenshots. You're going in, you're looking at the most recent lower highs, lower lows, higher lows on the daily and the 4-hour time frame. By the time you've done that, maybe just took a few trend lines on there, extra resistance, maybe looked at the previous day high, previous day lows. Fib, placing the fib on daily, then 4-hour time frame. Always just searching for this region in particular. You're smoothing out your analysis. You're smoothing everything out, more or less to a T. And we're really refining things. Always taking trades from either a bounce of the 61, a bounce within this region, or a bounce and rejection from the 78.6. Stop is always going to go 15 pips above. Target, again, mindful of the 0, the first B point here, and then target 1 there. So it's A, B, C, D. Okay, I hope that helps. With that being said, I'm now going to go over to a few examples. Now, GJ recently has provided some examples with this. Daily time frame, if you look at the moving averages here on the daily time frame's down. Got the key levels on here, nice and neat. If you go down to the 4-hour time frame in particular, now what we're looking for is, there was a setup around here. Now, this setup I went through at the Miami event, which took place last week. I have no daily highs, higher highs or higher lows on this chart. So what I'm going to do, I'm just going to go through this area in this region as I would have at the time. There is a lower swing high point. That was the most recent lower low at the time. We also have a point just here, right at the support. Confirming this lower swing high, the bearish engulfing, the tweezer top there as well, and it's directly bounced into and off the moving averages. Ones prior to that, I don't really need to go into that much detail, but we have this level here, and then also this level at this nice area of resistance. And I put the fib on, okay, after I've seen this one candle start to move to the upside, because that told me, okay, I have a leg there. This is now potentially going to be a bottom. I can now probably work from this one wave. With the fib tool, what we want to do, fib retracement, we want to go from the highs of the wicks as standard, as normal, and then down to the base point there as well. As you can see, I have a daily area support at 141.36, so sometimes if the support level or resistance level is already there, we can actually just average it and line it up with that level, as so. Now, GBP-JPY is quite a volatile character, a volatile instrument, if you will. So let's start here on the 4-hour time frame. What we actually seen, I did mention we can breach the 78.6 on a 4-hour, and here's an example of that. We breached above, we spiked above, however, by the end of the day, we've closed back below. That's why we need to check out if it's a daily closure above, it's invalid. Okay, the market's come down. Entry would have been after this candlestick right here. That's a bearish engulfing and shooting star. Okay. And we would obviously hold to our first target. However, look what's happened. We've come back into, markets come back above, spiked above, tweezer top once more, and back below. Okay. This would have been a case of, so we went 91, 15 pips above that would be 143.06. 143.06 right there. That would have got us nice tight stop after, okay, this candlestick here, you would have been stopped out. You would have been stopped out on that. However, the market provided us with a double top formation and another bearish engulfing and tweezer top there as well. So one rejection into the zone would have got stopped out by around 7 or 8 pips, adding the spread on there. Here we come up again and then we whip back down. There's your other entry at the bottom of that bearish engulfing. That confirms the double top formation. It confirms the second rejection of this. So your entry would have been 142.55. Your stop would have been, 1 second, right there. Stop would have been above, as I've just mentioned, 143.06. So line that up there as well after second entry. So first one failure, second entry. This is quite rare actually that it will do a double top at that. And then target 1, again, keep in mind what we have at the 0, and target 2 would simply be there. This is a risk reward of 1 to 2.4. Risking 55, 56 pips for 167. Okay. Market's come down, it's made its new lows, and then it's continued. Now, I say that's a rare opportunity, rare example of the market spiking so dramatically, but again, it is GBP-JPY. Let's take a look how this looks in comparison to the daily time frame. So we whip back below by the end of the day, up, and then whip back below at the end of the day. So this fib was still valid. What I also needed to do there as well, guys, is put in the rectangle. So this is how you would do it. Put in the rectangle, and that's that. So it can reverse within anywhere of that region. Going to the daily time frame and looking at the daily, look what we've seen on the daily. Daily time frame, we had a spike 1. Now this is our first peak. This is our secondary peak. Now look at, I also have 142.50 resistance here, as you can see. We have a shooting star formation. I can class these two as tweezer tops as well. So 1 daily rejection, 2 daily rejections. But look at the bodies. We've closed out and below the region. We've spiked through the moving average twice. We spiked through the MA twice. 1 rejection, 2 rejection there as well. That's another confluence. And then we've closed below as a shooting star. Market 1 day, boom, straight to the target. Continue through, and now we're actually tested. We tested 140, and GBP JPY is a little bit all over the place at the moment. So that was the most recent one on GBP JPY. I actually put that in the Telegram group as well. Any more on here? Consolidation is a bit all over the place, to be honest. Let's try this level from the highs here down to the lows, and we can clearly see that's one wave. Boom, back up. As an example, we can line it up with the resistance down to the support. We can't do it to this blue support as the market isn't touching it there, so we're just lining it up as an average of those wicks. And what we see here as well, so we have A. I'm just going to steal this. So we have A down to B. We have our Fibonacci region, which again fill that in with a rectangle. We've come in once, we've come in twice. But as you can see here, the difference between this and the first is that we have pin straight to it, pin straight to it. It isn't so dramatic as the first example. And then, boom, straight through the first target there as well. So you're going to find, if you backtest this, go through the charts, chart time, trial and error, you're going to find this come through over and over and over again. So a most recent one on GJ now, just because I'm intrigued myself. What we have on GJ, this is now a low, okay, multi-month lows, and we have this point here and then this point here. This point for me, we have a 3-pin formation, 1, 2, and 3 right off the moving averages there. So we could potentially take the highs of that lower swing down to the lows right here. So GJ for me, I do believe that it can pop up furthermore. If we go in and highlight this region, I am now set for, because I am still bearish on GJ ultimately overall, I'm set for a spike into this region anywhere down to short. So I sit on my hands now. I look at this 4-hour time frame. I utilize this daily time frame, 4-hour time frame, and I sit on my hands. I wait for the market to come through into the region, no confusion, in order to look for short opportunities in here to take it down to new lows. I am expecting GJ at 137.50 weekly support. So that's an example there. If we take a look at Euro USD, hasn't been behaving very well actually, but there is an example on the daily time frame. So Euro, if we look at the weekly, the MAs are up on the weekly, the MAs are up on the monthly as well. It broke out of its region finally recently. Okay, this is where it was trapped. This is the range I was talking about earlier on for some of the majors. So daily time frame, Euro USD. Now EU, I know that again, as you practice this over and over again, you become better, you become more fluent. So there's the most recent high, okay, which I'm expecting to be taken out soon. Where's the wave here? Where's the wave? There's one wave there, that's a daily. If I tried the fib from that daily wave, the next one would be, so that's a prominent higher low, and that's a prominent higher low, 3-pin formation, 3-pin formation. If I went from A up to B, as you can see, this region is far away. That's not to say Euro can't come into it. I might just find something better. So in the case of this, always step down to the 4-hour time frame. Again, key level should already be on your charts, and what I can actually see now, there's a prominent higher low here and one here. This one is favored because it's in line with my overall support. So if I just get rid of this as well, 1.1620 support. So I have the high spike and I have the lows there. So let me take it from lows to high, and I can average and balance it on the support up to the highs and bring it across. So up to the wick, as you can see, so we have point A and point B. What I then go ahead and do, rectangle, I go across, inward, and look at that. Now, Euro came back into the region once, twice, 3, 4, 5, 6, 7 times. Look at every single time. Spike through, bodies close above. Now, Euro USD for me, even though when we have, this is great on time frames where we see larger waves as well, because once you've seen it reject that zone, you now know, even if it's halfway to the target, there's a high probability chance, using this as a bias, that this can go up to our first target extension, which is just shy of 1.2 in this case. So this helps me with my overall bias on the euro, with the moving averages being up. We're creating high highs, high lows on a daily time frame, on the 4-hour time frame. I'm now looking for euro to continue to the upside to this level 1.1986. No confusion with the 38 or the 50. If you did manage to catch, the euro around this region, came in, reversed up, etc., stops again would have been placed at 1.1686, taking 15 pips off that. We're going to have 1.1671, 70, just to round it off. So that's the current piece on the Euro USD at the moment. What else do we have over here? We have, let me see if I can find something on GBP AUD quickly before I end this video. GBP AUD today, right, so daily time frame, let's bring this out. Daily time frame. Most recent, I think I did have one from the highs down to this low here. That might have even been a 4-hour. Okay, so this is a lower swing high on the daily time frame. I was expecting, when the market was consolidating around this region, I was very, very indecisive about this. If I tried to do a fib from the highs down to the lows, as you can see, we didn't fulfill any of that. So in this case of refining and using this refined fib, it's a no-go. It's fine. I'm leaving it alone. Now, if I look at, this is the most prominent lower swing high, I can clearly see that. Lows, we have a bunch of lows across here, but this is the most recent low right here, which it printed last night in the Asian session. I can try this fib from the highs into the lows. So I have A right at the spike, B. GBP AUD, similar to GBP JPY, is bearish for me, and I am expecting lower pricing. However, these pairs are quite volatile and they like to do what they want at times and pull back substantially. So what I'm waiting for now, GBP AUD into the region, and then boom, down into new lows. All I have to do is sit on this 4-hour time frame, wait for it, wait for the signal, wait for it to come into that before taking a potential short opportunity. Again, with this, risk reward is going to be quite something. Let's say we entered the break back below 61, stop above, so that's around 80 pips stop. Target, we're talking hundreds of pips as a target. So I hope you enjoyed the video. I'm always going to be going through this, and this is my method of using fib here on out. Hope you enjoyed the video. Again, guys, check this out. It's going to aid some confusion. We want to just keep things as simple as possible going forward. The other videos have showed you the variations of the fib, what the levels are for, etc., how to plot them on. But if we use this on a daily time frame and a 4-hour time frame, we're going to get the best risk reward setups. We're going to aid confusion. We're going to get tighter stops, and we are also going to get more clarity on the charts going forward. And you will find this if let's say you had 10 pairs open. From my personal experience, you will probably find this on 7 or 8 currency pairs, either on a daily or 4-hour time frame. So I hope you enjoyed the video. Thank you very much.